So people need to understand the multitudes of timeframes. But the macro timeframe is that at some point when we have the disorderly descent into the new system, it's likely to get very disorderly to the positive side for precious metals. There is technical setups that are behind that, such as a gold-silver ratio, the macro head and shoulders, that will see a run through the 32s as a gold-silver ratio. But first, we've still got to come back down all the way to the 65. So there's a number of layers in this. So I don't want people to run out, he's immediately bullish. I think we're going to be a bit dull short-term until around about the September market. We broke out, a couple of key levels were taken, but we've also only hit the 2,000 mark for the third time, and we're pulling back. So there's some winding up, some pause, some gestation. I don't think we dipped very far compared to the previous two events at the 2,000 level. And in fact, maybe it's best if I just bring the charts in here because I'm waving my hands around. And it's worth pointing this out actually on a bigger time frame. In fact, I'm going to shoot out to the monthly to start, and I'm going to just throw down some key levels here. When we overcame, we were actually involved in the bull calls of the 1,000 run. You'd only once had a small poke above the 1,000 mark. This was the 1,000. Very similar type structure. Had a poke above the 1,000 and a hard hit down. That coincided with 0708. Then you came very close to the 1,000, you got another pushback, and you came close again, you got another pushback. You got a very ascending structure. So you failed 3 times to win the 4th. And I'm just going to reiterate that. So it's tested 3 times, once, twice, 3 times, and then you smashed it. And you literally almost went to the next millennial level of significance, literally, because 2000 was not far away. You traded 1927 over here, and we find ourselves at the 2000 level over there. And in essence, we are having the same again. We're getting the test. Note this is monthly. We couldn't hold it on a monthly close at any point. So this is very typical of price behavior. It plays footsie with a line for a long time before it eventually does the necessary. But note, once you've got properly above something, it then serves as very fundamental support. So there's your first test. That was the 21 bull run. There's your second, and there's your third. And note also, you didn't come back down and visit that. That supports what, even though you had quite a strong bear market after the 1927 run there, you've now established yourself above the 1,000 mark. And in the same way, we are going through a similar process for establishing ourselves above the 2,000 mark. So you can see there's a sell-off there. This was actually a worse sell-off. This was the tightening of gold interest rates perspective. And initially, the Fed only did 0.25. We were wrong here. We called for a down move here, and they only did a 0.25 run. And in fact, gold ran up. But then they continued to do 0.75 4 times in a row. And this is the whole interest rates bad for gold. Well, actually, when you're creating that much money, you eventually came back up fairly strongly there. But we have again now once, twice, and 3 times resistance. And my opinion is that the next outcome leg is this. And the interesting part about when we showed up with you before is that we gave you a continuation pattern that had a $2,905 target in there. That actually takes you to the doorstep of the 3K mark, which the 1927 very much did for the 2K mark. So there's actually quite a decent uniformity and continual adherence to the very seminal key levels of significance for precious metals, which are the $1,000 marks. So this overall pattern structure, if I just remove some of my fancy drawings away and just say, this broadening structure, or even better still, this flagging process that broke like that, the target that got generated up there takes you to that $2,905 level, which is gateway 3K. And when we now combine that, you were going to ask about the gold-silver ratio. So why don't I just straight onto that to give you the full narrative? Why distortion? Because there was probably, it has to be said, an overhang of above ground supply at one point that is being whittled away at a very high level. And then, of course, manipulation of the derivative markets in terms of how you are set up is very seminally important. So here's the 65 line here, and I'll just sketch it again for you. And this is a rough cut head and shoulders. It's not traditional, but you mentioned in your opening segue about the failure of the bond markets and how we were behind calling that as part and parcel of the March 2020 events. And what essentially has occurred as a result of that is we also got peak debt and you got peak undervaluation of silver. Those two moments coincided literally here in the events of March 2020. You can see that was there. So if you, like me, see that the fact that the debt market on the current fiat system, which is unsustainable, unpayable, and has now got huge interest rate payments coming due for the dollar into 2024 on all of these rate hikes that are now starting to be baked in, that sees further proliferation, further weakness in the dollar, you should only be able to see gold advancement under these circumstances, debt devaluation, because money is borrowed into existence. Fiat and debt go hand in hand. You will borrow a currency into existence. So we are at peak debt. And this is what we refer to, and I'm doing it in black here, it's deadly dressed in black, a broadening structure overall, which is setting up for us what we think will be a right shoulder. And then you will come down again to that 65 level. So at some point, we expect this gold-silver ratio to come on back down like that, and then break this ascending grind line that we have here. And that will begin a fast journey of progress to 66. At that point, we think 65. We think it bounces a wee bit there at the 65, 66 range before going all the way to its target that we forecast of 32. So if you go back and think about that, if that's as part and parcel of gold reigniting and completing its target, where it will pause for a while, 2,900 zone to the 3,000 zone, then you will get to an area where it's, in essence, you are resting. And if, let's just say 3 grand for gold, I've made this case before, if you've dropped down to 65 during that period, you are talking the gold silver ratio having come back quite a lot, and you take gold and your calculation for silver will give you around about the $45 to $50 mark. And that's also the flag on silver's projection forward. So the gold silver ratio and relative valuation coming first step to 65 is the stage that takes gold to 2.9, which isn't going to be done in a day, a week, or even a month. I only expect it to recommence in September. So it's going to probably run into the period of 24 to even attain that. But during that period, you will have 75, you'll potentially have 45, my apologies, to $50. By the time we get to a 32 gold silver ratio, which is further forward in that, and let's say now you're guessing where's gold at that point, it could be at 4,000 or 5,000. If you're at $5,000 gold, and that could be 3 years later, you know, and we're having quite a strong move, bit of a pause, consolidation, then a strong move again, and you're at around a third, in other words, 33-ish gold silver ratio, you're going to be staring at the fact that if you're at 5,000 gold, you knock off 2 zeros and you times by 3, you're at about 150 gold. Yeah. $150, my dollars for silver, my apologies, not gold. But, and then the final stage that I actually assess, which was where you came in with Mr. Neumeyer's comments around how much silver he pulls out, a sub-double-digit gold-silver ratio would imply a 4-digit silver. So so you're sitting at 33. If eventually you go 9.99 sub 10 gold silver ratio, and you're sitting with gold at 5 or 10,000 and sub 10, you're on $1,000 silver. So that's for that extremist point where you have depleted all supplies above ground. The valuation of silver has reappreciated relatively, is still being physically demanded for industrial use sufficiently, and there's enough stackers for the, call it pet rock collectors, as we're probably going to be referred to, for taking up any surplus. They're actually going to have shortfalls. This is going to create a new necessity for mines. The only way I see this changing significantly is if we have, a complete planetary population decimation, and there's far less gold bugs, silver bugs, far less solar panels needed. And we can't rule that out. If everything else stays as it is for now, and those scenarios play out, there's quite a few different time frames to that. So I tend to prefer to focus on the next significant move. And that would be the breakdown to the 65 gold silver ratio and the move to 2,900 as part and parcel of a reignition of the gold bull market, which I anticipate when the bankers are back at their desks. So we're in the, markets gestate during the summer period for the Northern Hemisphere. You were mentioning the weather getting nice in Canada. It's also lazy season. You want to be out on your bike. You want to be out chasing bears in the forest there in your lumberjack shirt and every other cliche I can throw at you. And similarly for other people in their lands in the Northern Hemisphere. So it is a bit of a put on ice period, I would say. It's not to say that nothing significant happens, but September, October, November is a critical. A lot of gestation and a lot of things come to bear and get dealt with during that period. So you can have big sell-offs, for example, in the equity market. That could be possible on hypervaluation as people start to focus on debt. You've got to have an idea so to be successful in investing and also in trading, the difference, the primary difference is earning the right to an element of leverage in trading. The key difference is that you've really got to know when you want to engage the market. Entries matter. And at what point you accept your hypothesis is wrong. So I just threw out a random reason why a lot of what I'm saying could fail. But I don't think it's the probability. So we are stacking the probabilities, but not certainties. Whenever you're talking about the future, there's only certainties. There are no guarantees. So the on balance of probability scenarios are what I put forward. So you've got to have a level that you accept you're wrong and you actually close that opinion. And I have it technically based. When you're a chartist and you do 360-degree analysis, gold-silver ratio, gold against euro, gold against other currencies, gold against Bitcoin. I measure Bitcoin against gold. I measure Bitcoin against silver. I measure gold against Amazon. I measure Bitcoin against Amazon. Your one world retail tech company. Then I even look at other proxies, bond markets, debt markets. So you continue. I mean, our big oil short call to single digit that we're known for in 2019, the second half of that entire year, and repeated on stages in Acapulco in February when we were presenting, that was based on a gold to oil barrel ratio. And we saw a massive collapse in the relative valuations. And what people don't realize is that actually, apart from being short oil, that was only really one half of our trade. We were actually long gold from the breakout of that falling wedge all the way here, which was also an HVF structure the whole time. And if you look at a single candle of the events of March 2020 and the lockdowns, it's that. It sold off and it rallied up and went higher. This thing laughed it off, whilst oil traded zero in the cash market and negative on the futures market. So you actually got a super infinite crazy spike that actually is a nuisance because it spoils all forms of charting when you do gold divided by zero. Because the minute you start dividing an item by zero, you get ridiculous spikes on your chart. So that was a long short commodity trade, but one was a more monetized commodity. One was an economic activity commodity. And the other was a loss of confidence in money. The solution was the proliferation of fiat that drove the gold. And of course, the sizing down of economic activity destroyed the demand for delivery, packages, driving, holidays, flights, etc. And that killed oil. So yeah, quite a lot for you to unpack there. So let me shut it for a second. I, for interest's sake, am fundamentally curious and interested. In terms of the trade and investment decisions, it's entirely technically based. The thing is, you can't serve two masters. If you're waiting for narrative, so I call narrative a bit like the bedtime story for kiddies. People are affixed with narrative. If I waited for narrative, I would have only been putting the oil short on once lockdowns were being mooted and everything else. We were already in situ because of technical reasons. So I talk about the silver coin and the head and the tails. And in essence, you are watching the same market, but when you observe the back end that is technical, you actually are getting the fundamental news before everyone else. We had Aramco that was listing, a $1 trillion cap listing that was all happening just prior. That to us was absolutely to be expected. It gave us further confirmation. This is patsy stuffing. This was because, of course, as soon as the oil price collapsed, all those shares collapsed and they bought them all back. Essentially, the benevolent Saudi kingdom was now saying, we want to share the wealth of the nation here, public buy. and all of this, and everybody rammed in and sold all their life savings to buy Aramco. The oil price traded zero. Those shares and that listing crashed, and of course the same people bought the company back, and they actually got other people to pay and buy for the listing and continue to probably have near to 100% shareholding. But they got all the capital in on the listing of selling their company, and they got to buy it all back for a fragment of fractions of the price. So that's classic insider stuff for people that know events are coming down, and that you don't get that fundamentally. You get it when they choose to tell you through their media channels. Unless you are an insider in a cartel, you're not going to be the one to know. So a couple of, just while we talk silver, because it's Wall Street silver after all, here's that $45 chart, which is the pole. You'll see the pole there. That should be roughly there on the low, and that is around $45. Typically targets are just run. Now I want to highlight something on silver when we talk about this. If we go to, and I'm going to take you to a far larger time frame on this. I'm going to take you to a far larger time frame. Let's go 3 months here. I want to highlight to you, if you think back to that gold at the $1,000 mark, there was 3 touches and then it spiked and ran, it just mooned. This is very similar, an ascending triangle. I'm actually just going to take all my annotations off, so we blank the chart out to make it really simple for people to understand. Those black lines are alerts that I've set for notifications if we go up or below. This is a very similar structure. So that was the 2007-8 credit market crash. Everyone rushed into the dollar, slammed its way down. That was, again, gateway, $45 to $50 range. Then you got up here again, $45 to $50 range. That was the 2011 run. You had the March 2020 events that gave you a final dip value buy. I bet JP Morgan was jumping in there big time there and securing silver at $11+. And then we are waiting the next visit. Now I highlighted that you were going to, I had a target with 45, which brings you again roughly here to that. I expect again that we'll be knocked back, much like what gold is doing now, because it's failed to monthly close above the 2000 and it's done a third visit. It's not on the third that you win. It's the one that follows the third. So it's 3 times. 3 times you knock on the door, the 4th time you boot it down. That is kind of, call it the 3-letter agency's modus operandi for a home invasion. And this is kind of pretty much how price behavior is. However, the pullback after the third is usually much shallower than any of the preceding ones. And if you'd watch that gold at the $1,000 mark, the biggest was the first, the second biggest was the second, and then you just had a minor touch, and it's a lot calmer, and there is a squeezing of the volatility, which is why we trade what's known as hunt volatility funneling compression method, which is observing when the volatility is reducing. That is the best time to get in the market because you get super tight stops as a trader and also as an investor. So a trader is just a hyper adrenalized version with leverage of investor. Investors still need stop losses. Don't round trip. I mean, I've got people who bought Solana at, and it went from $20 to $260 and went all the way back down to 11. And they've round tripped everything from a mega P&L positive all the way back down. And you even get the certain amount of that with silver. The 45 to 50 range, I am on leverage trades going to take profits, and I may even sell a small amount of investment. And then I'll just be looking to buy it back up at the 33s and 34s. Right. But I don't overtrade long-term investment. But with leverage and a shorter time frame where you've got to be more accurate, you want to do that. So we're going to get a third run, and then we're going to get a pullback, and it's going to go super sleepy, and everyone's going to get bored as all hell. And that's when everybody stops watching and goes to sleep. And that's when we get interested, because the move that comes, the bigger the sleep, the volatility compression, the bigger the eventual move. This structure has already given you incredible geometry. You've had $50, and right down here, you're around 3. That is enough. That's about $47 in of its own. If you get a $47 move from a $47 or a $45 to $50 range, you're at the $100 next mark. So the geometry that's already been created is all in and fixed for us in HVF method. We're just waiting for everyone to get bored again after the third move up. So there'll be an excitement phase, a boredom phase, a low volatility phase.